Hello, my name is Michael Landsberg, Chief Investment Officer of Landsberg Bennett Private Wealth Management. Welcome to our second quarter market update. Obviously, the war is currently and continues to overshadow most of what goes on. It's driven the price of oil significantly higher. The concern is going to be, the longer it lasts up here, the more possibility we have for higher inflation and potentially a recession. Let me walk through some of the catalysts that we see that were happening kind of prior to the war and still continue. We believed inflation was going to be heading back towards 3%, regardless of kind of the incursion into Iran. We'd seen in the last 6 or 8 weeks prior to the war, oil had started to creep back up higher, and oil is a huge component in part of the calculation for CPI. We also saw the price of food commodities start to move higher. So we'd kind of built into our models that we expected to see inflation ratchet back towards 3% by year end. We're actually going to see 3% inflation probably this month. And so obviously it's pushed kind of our calculus up much quicker to have higher inflation. Higher inflation, albeit, is not a great thing. We don't see it going back to 9% as it was in the previous administration. But obviously heading towards 4% is certainly not heading towards the Fed's target of 2%. This puts really the idea that there's going to be some Fed rate cuts pretty much off the table. Likelihood right now, the longer this goes, the more likely you are to see a Fed hike than you are to see a cut, given where inflation starts to go. So again, we think we're going to see north of a 3% print for the March CPI, which will be reported in April. And we think it continues to ratchet a bit higher. That backdrop, obviously, is a tough environment for investing. So what you've seen us do in the portfolios, and I've used the fog analogy a lot, I like it. So when I like something, I'll ride it. But the idea is you can't see clearly. You're on the road and the fog comes in and you can't see clearly. You can still see well, so you can continue to move forward. But what we're not doing is pulling to the side of the road. We've all been on roads where it's kind of either raining hard or it's foggy, and you almost hit somebody because they pulled on the side of the road. They're not really off the road, they're in the side of the road, and bad things can happen when you stop moving. We find that's the case with stocks. Yes, you get out of the market, you wait for the market to come back, and you're going to put it in at the absolute right time. You go to cash, and then there's a resolution, and the market rallies significantly, you don't get any exposure. As you know, market historians will tell you the top 10 or 15 days in a year pretty much make oftentimes the big rallies in the year. So if you miss those days, you're going to be out. So our goal in this environment is with every environment, is when we see some choppiness, is to kind of slow down our speed. We've added, for example, some cash to the portfolios. We've actually looked at some of the areas that were kind of overexposed to some of the more volatile areas. We've reduced that exposure. We've added some shorts, which give us some stability when things are going down. And we've recently increased our exposure to energy stocks. And between adding some additional oil exposure and energy stocks, they typically do well in these geopolitical environments. The goal, for example, isn't to completely avoid the downside, because if you do, you completely avoid the upside. The goal is oftentimes to mute the downside. By having some things that kind of zig when the market zags, you have the ability to kind of hang in there longer. You've seen that in the last 45 days. As the stock market has fallen quite significantly for 45 days, our accounts haven't. And the reason is we've kind of taken our foot off the gas to some extent. We're still moving forward, but we've decided, listen, we're going to take some of this big risk out. Many market participants will keep driving at full speed into the fog, and it may work out for them. The flip side of that is it may not. And ultimately, for many of you, the bucket you've got right now is the bucket that we have to use for the rest of your lives. And so we can't afford to lose a third or half the bucket because we wanted to push the edge of risk in a time where we can't see clearly. I often talk about visibility. And for the last couple of years, we've had some pretty good visibility on economics, what's going to happen, tax policy, things like that. All that's kind of out the window right now because there is no visibility. So the ability to drive faster is great when there is good visibility. We have visibility is, again, on job data, inflation, economic growth, and earnings. The only thing we've got some visibility on for the most part right now has been earnings. But again, the longer this war goes on, the companies that are affected by higher energy prices, we're going to lose some of that visibility. So while we're still positive on earnings going forward, we're a little bit less simply because we can't see. And rather than kind of investing in the market we want to have, I learned a long time ago, you need to invest for the market you have. The market we have right now is every few days there's a different tweet. We don't know what's really going on. Are there going to be boots on the ground? Are they not? Is the war being effective? Have we knocked out energy? What's happening in the Strait of Hormuz? A lot of these things are unknowns. And when you have unknowns, you have to kind of take your foot a bit off the gas and be less aggressive than you would be. So that's kind of where we are. We've also seen a shift where interest rates have started to move higher. And that's not a U.S. thing only, it's a global thing. German 10 years have also hit highs. The Japanese bonds have moved high, even though they're very low historically. All interest rates have moved higher. And that's why actually bonds, again, haven't held up particularly well during this kind of fall. They've held up better than stocks, but bonds are still negative during this incursion into Iran. That's one of the reasons 5 years ago we added, or 4.5 years ago, we added exposure to alts, to the golds, to the commodities, to the oil, to things like that, long short funds. And they actually have been positive during this environment. There's kind of a method to that madness, was having something that's entirely different than the other two asset classes works in environments where it's unpredictable. So you'd think if there's a rush to safety that a bond should do well. Well, again, they've done better than stocks, but they still lost money. Where the alts did well. Gold has done well over the last year or so, and the last quarter has been okay. Oil has done pretty well, and you've started to see the food commodities kick up. And again, that's for the most part 20% of our portfolios. So we've got that ability for 20% to kind of deflect some of the pain that we're seeing in some of the stocks. And again, we typically look at allocations and make sure that we're not over our skis a bit too much in terms of risk. So one of the things that we've historically been able to do is when we look at risk, we're able to manage the risk that we take in the portfolios. I can't tell you if stocks are going to go up next week or the next month or the next quarter. What I can manage is how much risk we take in that environment. So in January, per our rebalancing, we trimmed back our risk exposure. Why? Because 2025 was a good year. Every 6 months we look and we typically either trim back risk exposure or we add risk exposure based on how the market did. So when the market does well, we typically want to take it down a notch. When we have a poor quarter or two, we want to up it. So let's say that this kind of fog doesn't lift for a couple months and we're at the July rebalance. You might see us add some percentages back to stocks because stocks have come down from where they should be. Typically we do that when we have a bad environment because we want to be buying low. The ultimate goal is obviously to buy low and sell high. Most investors get that backwards. They sell when things are cheaper and then they buy when things are more expensive. This discipline makes us look at things twice a year as to where we should be adjusting the risk. Again, the risk is the one thing what we can look at, and we know we can control how much risk we're taking, and that's important. Again, the stocks that are out there, the companies that we own, earnings have been very good. So we're still very positive about the companies that we own. We just got a little bit less visibility, and we have to kind of understand that as much as we want to go faster in terms of allocations to stocks, we've got to go a little bit slower given the fact of kind of where we are. In boating parlance, it's almost like it's a no-wake zone right now. We're kind of moving, but we can't actually stop because obviously stopping's not going to be helpful. We all have goals to achieve, whether that's trips, a retirement, continuing to fund educations, weddings, etc. And those are going to come whether we're prepared for them or not. Our goal is to continue to kind of move towards those goals. So what we think is going to happen again is this war is going to drag on as long as the war is going to go. We have positioned for it to go on longer for the idea that I'd rather be a half glass empty investor. I don't want to, many people are like, oh, this will be over in a weekend, or, the president was saying this will be over very soon. Well, it's been over a month and it's not over. And I'd rather look at the idea that this may drag on for months and maybe quarters and not days and weeks. And if we're investing that way we're making sure we're protecting the downside. The number one thing we always worry about is protecting the downside. So in environments like this is really where we earn our money, is making sure you're not going down as much as the market. There's a lot of big stocks out there, very well named, name brand stocks. They're some of the largest in the world that are down 15 and 20% this year. You're down nothing near that. And that's important because when things are going down, you want to avoid the losses as much as possible. And that's what we've been able to do. That's what we'll continue to do, or at least try to do from a standpoint of what risk level we take. Again, we want to make sure we're progressing towards your goals and objectives, but again, sometimes we've got to go slower. If this was a marathon, and investing is, we're currently jogging. We're not running anymore, we're jogging. We're not walking, we're not stopped, We didn't hop on the subway and try to get around it like that lady did back in the day in the New York City Marathon. But the idea is we're not running full speed anymore, but we're still jogging towards where our goals are. The hope is we can start running again in the next weeks and months. Maybe not. Maybe we have to start walking. Maybe we have to slow our pace even more. What we don't know is what we don't know. We don't know how long this is going to last. But at the end of the day, our process is to protect the downside, to look for the areas that are going to do well, that are continuing to grow, even in the face of this uncertainty. And obviously the area that's continuing to grow is energy. We all need it. We're going to see that. And that ultimately does affect the rest of the portfolio, because energy stocks, historically, when they do well, the price of oil's higher. That's like a tax bill for the rest of us. Every other sector has less money to be spent if I've got to spend over $100 or $125 every time I go to the gas station. And that continues to happen. So as oil ramps higher, a lot of those discretionary items that we like to buy, they get down. So we own less of those now, because as energy prices go up, our ability to spend money on kind of nonsense goes down. Staples continue to do well, but the idea is things that we don't really need, that's where some of the pain starts to happen. So we've underweighted that sector, and we've overweighted the energy just to protect ourselves. And again, we'll be in touch, whether it's communications via email or, more videos that we'll send out, whether it's me through this venue or through some of the popular media channels. The goal is for us to continue to kind of look at the pace that we're on, continue at that pace. And if things change and deviate, we'll make those changes. The goal with our portfolio is always to tweak, but when there's two roads and kind of two forks in the road, we'll always take the more, let's call it the more conservative road, because I want to make sure that, that road might be faster, but there's a lot of potholes, a lot of bumps. We don't really know what's over there. This is going to be the road, again, that I've got a little bit more visibility. It's paved, and there's a little bit more, let's say it's well-traveled a bit for us to be able to make sure we get you to where your goals are. Thank you for the trust and confidence you place in our firm. It's our pleasure to be able to serve you. If you have any questions or concerns, please feel free to reach out to us, either by phone or by email, and we'll be happy to help you. Again, thank you for joining us.